Thank you for joining Mayor Brown's webinar. Our program today will focus on preparing for the 2019 U.S. Proxy and annual reporting season. I will cover a few administrative items and then we'll get started. First, at the bottom of your screen, you will notice there are multiple application widgets you can use. All of the widgets are resizable and movable, so feel free to move them around to get the most out of your desktop space. If you can expand your slide area or maximize it to full screen by clicking on the arrows in the top right corner. Today's program is being streamed through your computer. For best audio quality, please make sure your computer speakers or headset are turned on and the volume is up so you can hear the presenters. For the best viewing experience, we recommend using a wired internet connection, preferably with Chrome or Firefox browsers, and closing any programs or browser sessions running in the background that could cause issues. Some networks cause slides to advance more slowly than others, so logging off your VPN is recommended. If your slides are behind, pushing F5 on your keyboard will refresh the page. You can find additional answers to some common technical issues located in the Help widget at the bottom of your screen. During today's presentation, you will be provided with an alphanumeric code. If you are applying for CLE credit, you will need to record this code on the virtual sign-in sheet that you received by email with the connection details. You can also find a copy of the virtual sign-in sheet in the resource list widget entitled CLE Affirmation Form. Directions for returning the CLE affirmation form are on that sheet. We will read the code in the middle of the presentation and then again at the end. Please note, we have also made the event valuation form and presentation deck available in the resource list widget for your convenience. This webinar is being recorded as we normally do with these programs. In a day or so, we will be sending you an email with a link, which you can use to listen to the webinar again or share with your colleagues. The recording will also be posted on Mayor Brown's website. We plan to try to leave some time at the end of the program for questions. To submit a question electronically, please use the Q&A widget. If we don't get to your question during the webinar, or if we haven't left enough time at the end, we will make every attempt to follow up with you after the webinar. My name is Mike Hermson. I'm a partner in the corporate group at Mayor Brown here in the Chicago office, and I'm delighted to participate with my colleagues Bob Gray, Candace Jackson, Anna Pinedo, and Laura Richmond. Bob is a partner in our corporate and securities practice in the Houston office. He has advised boards of directors as well as audit committee and special committees of public companies in many industries and corporate governance matters. Bob has represented a variety of public and private companies, underwriters, and equity investors' venture funds in private placements, public offerings, and mergers and acquisitions. Candace is a corporate and securities associate in the Chicago office and advises public companies in connection with corporate governance and reporting obligations under the Exchange Act and the NYSE and NASDAQ rules. She has served as both in-house and outside counsel, most recently as an assistant general counsel at U.S. Foods. Anna Pinedo is a partner and co-leader of our global capital markets practice at Mayor Brown. She concentrates her practice on securities and derivatives. Anna represents issuers, investment banks, financial intermediaries, and investors in financing transactions, including public offerings and private placements of equity and debt securities, as well as structured notes and other hybrid and structured products. Laura's wide-ranging practice, corporate and securities practice, has a strong focus on corporate governance issues, SEC reporting obligations, and stock exchange requirements, including proxy statements and related executive compensation disclosure matters, annual reports, board of directors, and Dodd-Frank and Sarbanes-Oxley compliance. And she is located in our Chicago office also. With that brief introduction, let's get started with today's program. Before the other panelists get into the nitty-gritty on some of the important matters to consider when preparing for the upcoming proxy and annual reporting season, I want to get us started with a couple of bigger picture landscape items. Besides complying with the disclosure requirements or dealing with shareholder proposals or similar matters, you should be aware and keep in mind some other activities going on that may also impact how you comply with meet your disclosure requirements, how you provide disclosure, particularly in proxy statements, and how and when you communicate with shareholders and what you communicate with shareholders. I want to touch on three matters: governance initiatives, potential proxy advisory regulatory changes, and a resulting trend we are seeing in proxy statement disclosure. We are seeing a number of efforts lately, driven largely by institutional shareholders, focused on what I will loosely call governance. To mention just a couple, in no particular order, first is the Boardroom Accountability Project 2.0 from the New York City Comptroller and the New York City Pension Funds. Last proxy season, they focused on 151 companies in an attempt to have standardized matrix disclosure that would hopefully make boards more diverse, independent, and climate competent. The short of it is that didn't happen. But they were also a leader in proxy access, so it's likely that we will see further steps in this area from the Comptroller. If you want to see what the matrix that the Comptroller was proposing, I've included on the bottom of this slide a link to the web address that you can go take a look at, and you can sort of see what it is they're proposing. And like I said, I think we're going to continue to see some more activity from them on this front. It's not going to be completely dealt with in 1 year. The next one I want to talk about is Vanguard. In 2017, Vanguard sent an open letter to directors of public companies worldwide. In that letter, they set forth their 4 pillars they use to evaluate corporate governance practices when making voting and engagement activity. In 2018, they reported on these pillars in their Investment Stewardship Annual Report. What are the 4 pillars? Having a functioning, well-composed, independent, diverse, and experienced board with effective ongoing evaluation practices, having provisions and structures that empower shareholders and protect their rights, having pay that incentivizes relative outperformance over the long run, having effective, integrated, and ongoing oversight of relevant industry and company-specific risks. The third one I'm going to mention is the BlackRock Investment Stewardship Engagement Priorities. Their investment stewardship team engages with companies to understand their approach to corporate governance, including the management of relevant environmental and social factors. They focus on 5 key points: board composition, effectiveness, diversity, and accountability, board review of corporate strategy in light of shifting assumptions, executive pay policies and how closely they link to long-term strategy and goals, enhancing understanding through consistent disclosures of the processes each company has in place to manage climate risks, and in a talent-constrained environment, do they have a high standard of human capital management, which they consider to be a competitive advantage. One of the reasons for company engagement is because company disclosures haven't always provided sufficient information to fully inform their assessment of the quality of governance. BlackRock, like some of the other large institutional investors, has published voting guidelines that are available on their website. Again, on this page, I've included the web address to their voting guidelines. And it's important to keep these in mind, either of BlackRock or some of your other large shareholders that they're out there and how they might view certain practices or things that you're considering. These are just 3 examples. There's many more. I've included a list on these next 2 slides of some of the other ones. We've got State Street Global Advisors, CalPERS, CalSTRS, the Investor Stewardship Group, which has a set of corporate governance principles for U.S.-listed companies, and the most recent Common Sense Principles 2.0, which just came out in the last week, and are a set of corporate governance principles that were signed on to by 21 CEOs, including those from GM, Dow DuPont, Berkshire Hathaway, and JP Morgan Chase, and institutional investors such as State Street, Vanguard, and T. Rowe Price. You can find information about all of these examples and others that might be reflective of your shareholder base just by searching on the internet. And that will give you some really helpful guidance. There's a couple of changes out there that could impact proxy advisors. The first comes from Congress and the Corporate Governance Reform and Transparency Act of 2017. This act would amend the Exchange Act to create requirements to foster accountability, transparency, responsiveness, and competition in the advisory firm industry. I think one of the goals of the legislation is to provide greater regulatory oversight of the proxy advisory firms with the goal of reducing the considerable amount of sway that some think they have. The second comes from the SEC. The SEC announced that it is going to be holding a roundtable next month to discuss the proxy process. One of the items expected to be on the agenda is proxy advisory firms. Last month, the SEC's Division of Investment Management withdrew 2 no-action letters addressing the ability of registered investment advisors to rely on proxy advisory firms. And the reason they withdrew those letters was to help facilitate a better discussion of the topic at the roundtable. But the SEC also created some inconsistency on this topic. The SEC's Division of Corporation Finance and Investment Management have issued Staff Legal Bulletin 20 dealing with proxy voting, and some of the things that were in the letters that were withdrawn are also in that Staff Legal Bulletin. So there is some conflicting information out there. In any event, either the legislation or SEC action likely won't have any impact on the upcoming proxy season, but it is something to put on your radar screen. So what is the one trend that we are seeing and we expect to continue? That is using the proxy statement as more than just a disclosure document to be used in connection with soliciting votes for the annual meeting, but also to use it as another means of shareholder engagement and making sure the company is able to communicate to its shareholder base and other interested parties the information that those parties are interested in. It's a means for the company to get its message out and to craft its message. Some shareholders look for specific information in a proxy statement. It's important to know the shareholder base and what type of information those shareholders are looking for. It's also a good way to disclose things that ISS and Glass Lewis might be looking for that go beyond the SEC disclosure requirements. So what are some of the things that we are seeing that I think come within this area? One of the first things is, there are things like, and these aren't in any real particular order, but we're starting to see things like a letter from the board or the board chair that can be used to convey information about the board structure and oversight function, among other things. Summaries. This has been an expanding area. It probably started first in the C&DI, but now has expanded, and we're now seeing more summaries of the proxy statement as a whole. It's helpful in pointing readers to certain information that they may be interested in, but may otherwise be hard to find in the proxy statement. We're also seeing summaries of ESG efforts and other sort of specific topics that are undertaken by the company. Some investors only look at the summaries to help them decide what they should focus on. They don't have time to read every proxy statement in detail. So shortcuts both help the company craft its message and help the shareholder get right to the information it is interested in. We are seeing more discussion of the issues that have been raised during shareholder outreach during the previous year and what steps are being taken or have been taken to address those issues. Finally, we're seeing continued efforts to present information in an easy-to-read format. This is a continuation of the SEC's plain English efforts, as well as its encouragement to present information in alternative ways, such as through the use of graphs, charts, bullet point lists, tables describing what we do and what we don't do, etc. While legal compliance has its place, it isn't necessarily the easiest way to convey information in a manner that will be easily understood. This is really something that should be looked at when the important takeaway from disclosure might get buried in the more traditional textual disclosure. Some areas that come to mind that are good candidates for this include director skills, compensation components, and information supporting compensation decisions, and important operating metrics. The final thing I want to mention are audit committee reports. We are seeing audit committee reports expanding to provide more information than just that required by the SEC's rules, to include more information about the functions performed by the audit committee, for example. In particular, one area that we are seeing more information on is areas that deal with risk management and risk oversight. And with that, I'm now going to turn it over to Candace.
Thanks, Mike. Well, we've almost made it through the first year of pay ratio disclosure. So Today we'll take a look at what we've seen so far. Jumping right into the first slide, you'll see that larger cap companies are reporting higher pay ratios. Looking at the Russell 3000, the S&P 500, and the S&P 100 indices, that's mostly consistent at all points from the low end to the high end of the range. The median CEO compensation for the Russell 3000 is about 71 times that of the median employee. For the S&P 500, the median is about 160 times that of the median employee, and for the S&P 100, it's about 218 times that of the median employee. By industry, I think, no surprise here, consumer retail has reported some of the highest pay ratios across the three indices. For the median employee compensation, there's not a lot of variation across the three indices at each point along the range. The median for the three indices has ranged from approximately $64,000 to $77,000. For the format and placement of the pay ratio disclosure, while there have been some companies that have presented the pay ratio in tabular format, generally companies are disclosing the pay ratio in narrative form, following the compensation tables and the change in control payments disclosure. As for the use of supplemental pay ratios, only about 10% of all filers use the supplemental pay ratio. We are seeing supplemental pay ratios being used to present both a lower pay ratio and sometimes a higher pay ratio, as we'll see in just a moment. Generally, companies are making adjustments to exclude non-recurring compensation components or to exclude part-time, temporary, or non-U.S. employees that they otherwise could not exclude. These examples show the exclusion of a transaction bonus and the exclusion of a one-time equity award. And both of these companies presented their supplemental ratios to reduce the pay ratio. Other supplemental ratios reflect adjustments that increased the CEO's compensation to avoid presenting a misleadingly low pay ratio, which is something companies should consider when they think about how a ratio might be compared year over year. A few examples here, Willis Towers Watson annualized a one-time multi-year performance award that had been paid in 2016, and they included the amount attributable to 2017 in their supplemental ratio in order to better reflect the CEO's true 2017 compensation. In the second example, CVS applied a future methodology change to their 2017 compensation to show that had the change taken place in 2017, the CEO's 2017 compensation would have been much higher. Turning to the median employee, as you know, in identifying the median employee, companies are required to include their full-time, part-time, seasonal, and temporary employees in the U.S., as well as employees outside of the U.S., with two exceptions that we'll discuss in a moment. We've seen companies generally using the full employee population to identify the median employee, with only about 2% of all filers and about 13% of the S&P 100 using a statistical sampling of employees to identify the median employee. When initially identifying the median employee, companies are permitted to use one or a combination of compensation metrics that make sense for their own facts and circumstances, as long as they're generally applicable across the employee population. As you can see, most companies use base salary and a combination of other metrics, including bonuses, equity awards, commissions, and overtime pay, among others. As I mentioned a moment ago, there are two ways that companies can exclude non-U.S. employees from their employee population that they use to identify the median employee. The first is the data privacy exception. If non-U.S. employees live in a jurisdiction where data privacy laws would prevent the company from complying with the pay ratio disclosure, the company can exclude those employees. There are some caveats to the use of this exception. For example, the company is required to make a reasonable effort to use or seek an exemption under the restrictive data privacy law. And so far in 2018, we have not seen any companies rely on the data privacy exception to exclude non-U.S. employees. The second exception is the de minimis exception. So if fewer than 5% of a company's total employees are non-U.S. employees, they can all be excluded from the employee population under the de minimis exception. Companies with larger non-U.S. employee populations can also exclude up to 5% of their non-U.S. employees. One caveat is that companies cannot exclude employees in jurisdictions where there are more than 5% of the company's total employees, because if a company excludes anyone in a given jurisdiction, it has to exclude everyone in that jurisdiction. And since there's a 5% cap, if a jurisdiction has more than 5% of the total employees, they cannot be excluded. Another caveat is that employees excluded under the data privacy exception count towards the 5%. But the data privacy exemption permits companies to exclude more than 5% of their total employees. And so once they've done that, they're unable to use the de minimis exception to exclude any other employees in non-U.S. jurisdictions because they would have already reached or exceeded the 5% cap. About a quarter of all filers have used the de minimis exception, and about a half of the S&P 100 have relied on it. Here we see a couple of examples of companies disclosing their excluded employees from non-U.S. jurisdictions in both tabular and narrative format. So a few considerations on pay ratio disclosure. Pay ratio disclosures are considered filed and not furnished, and therefore are subject to CEO and CFO certification and to potential securities law liability. As we move into year two, it's a good time to start thinking about how the pay ratio is being perceived by employees, investors, and the press. Local newspapers may focus on the disclosures of large local employees. For example, the Seattle Times published an article earlier this month on Microsoft's pay ratio. It's a good time to start engaging with shareholders on pay ratio disclosure. And as I mentioned before, consider also how the pay ratio may be compared year over year. Pay equality is a big political issue at the local, state, and federal levels. In Portland, Oregon, a law has been passed that will tax corporations in the city that pay the CEO more than 100 times that of the median employee. And other jurisdictions are considering similar measures, so that's something to just keep in mind. A bill was introduced in 2016 in the U.S. House called the CEO Accountability and Responsibility Act, which would also increase tax rates on companies paying the CEO over 100 times that of the median employee. Just a few quick updates on other pending Dodd-Frank rules. In the fall Unified Regulatory Agenda, it's been indicated that the hedging disclosure rule continues to be in the final rulemaking process. It's not clear whether the final rule will be approved in time for the 2019 proxy season, but when the final rule is issued, it may be advisable to amend hedging policies and revise D&O questionnaires to capture information about hedging activity. As far as the actual disclosure goes, many companies already discuss hedging policies in their CD&A. There has not been any change in the status of the clawback proposal in the last year. And there has not been any change in the status of the pay for performance proposal in the last year. So stay tuned for more on those.
And with that, I'm now going to turn it over to Bob Gray to continue the program.
Thank you, Mike. Today I'm going to discuss 4 key areas for consideration in this year's upcoming proxy season: stay on pay, disclosure of perquisites, virtual meetings, and this summer's 6 significant C&DIs applicable to proxy statements. As everyone now knows, say on pay has become an important feature of annual shareholder meetings. Although say on pay is an advisory vote, there are real consequences to a failed say on pay vote. Generally, if investors holding a substantial amount of a company's shares, even if less than a majority of the shares voting at the meeting, vote against the compensation of the named executive officers or NEOs in the proxy statement, they will expect the company to make changes to its compensation program. Proxy advisory firms, such as Institutional Shareholder Services, ISS, and Glass Lewis, have become very influential in the say-on-pay process. As a result, if a company receives a negative say-on-pay vote recommendation from a proxy advisory firm, it is often, but not always, prepares additional material in support of its executive compensation program. According to a similar Proxy report, when ISS recommends an against a say-on-pay vote, shareholder support for the proposal is 31% lower than at companies that receive a for recommendation from ISS. Although an against recommendation does not always result in a failed say-on-pay vote, the drop in shareholder support may influence the ongoing level and tone of shareholder engagement on compensation matters, director nominees in the coming year, as well as future votes on say-on-pay and director elections. So, what were the 2018 say-on-pay results? As you can see, according to the September 21st, 2018 report from Stephen Hall, of the 2,640 companies that held say-on-pay votes in 2018, through that date, only 60 companies, 2.4%, failed to receive a for vote. But more than half of the fails had negative total shareholder returns in the prior year, leading the firm of Willis Towers Watson to suggest that the votes were more related to a say-on-pay for performance, particularly when compared to peers. Therefore, the compensation discussion and analysis, CD&A, in the proxy statement has taken on greater importance. That is, how a compensation program works and how it supports the company's strategic objectives is both for the shareholders and shareholder advisory groups that they follow. What items should be considered when drafting CD&A to improve the chances for a for vote on say-on-pay? Specifically, CD&A can impact say-on-pay if viewed as more than a check-the-box compliance requirements, if it provides a rationale for how the compensation program ties to and supports the shareholder value and strategic goals, highlights any improvements made in response to feedback or otherwise, discusses any hot buttons directly and how they support shareholder value, and, if appropriate, sets forth a quantitative analysis of historical pay versus performance. Finally, and perhaps obviously, making CD&A, as Mike said earlier on, user-friendly can also impact say-on-pay results, including providing an executive summary, using graphs and charts, and drafting in plain English. Let's turn now to perquisite disclosure and enforcement. Notwithstanding the SEC's 2006 guidance, which we'll get to in a minute, it's not always easy to determine what is a reportable perquisite. As a refresher course, what are some of the common benefits that, if paid by a company to an NEO, could likely constitute a perquisite? Here are some of the usual suspects. Indeed, just this year, a major U.S. company was the subject of an approximately $2 million SEC penalty for failure to report, among other things, NEO's personal use of corporate jets and company-paid club memberships. Therefore, when evaluating whether any of these items provided by the company to an NEO is a reportable payment and how, what can we discern from the SEC's guidance and rules? This is a bit busy, maybe, but let me just go through it quickly. Is the item integrally and directly related to the duties of the NEO? If yes, it may not be reportable. If no, does it provide a benefit, direct or indirect, that has a personal aspect, even if for some business reason or convenience? If no, not reportable. If yes, the question is the benefit generally available to all employees on a non-discriminatory basis? If yes, not reportable. If no, is the aggregate value of all perquisites for such individual less than $10,000? If yes, not reportable. If no, disclose the perquisite in summary compensation table, and if the value is greater than $25,000 or 10% of all perks for such individual, then disclose the perquisite separately in a footnote with its value. Now let me turn to virtual meetings. The practice of holding virtual meetings continued to grow during 2018 proxy season and is expected to increase even further during this coming proxy season. Online shareholder meetings can take a variety of forms. Some are hybrids with in-person meetings supplemented by audio and or video options. Others are conducted as fully virtual or virtual only, as I'll refer to, virtually only meetings. The ability to hold virtual meetings is governed by a company's governing corporate law, charter, and bylaws. It's interesting to note that 30 states allow virtual-only meetings, including notably Delaware and Texas, while 42 states allow hybrid meetings, and 9 states preclude virtual-only meetings, including, again, notably New York. Broadridge has reported that during the first 6 months of 2018, public companies held 212 virtual meetings, up from 180 compared to the first 6 months of 2017, and estimated that the number of companies conducting virtual annual meetings during the full year of 2018 will be at least 300, up 30% from 2017, with a large percentage being virtual only. However, some investors have criticized virtual-only meetings. For example, not surprising, the New York City Pension Fund adopted a policy in its proxy voting guidelines in April of 2017 to vote against incumbent directors serving on a nominating committee who are up for election at a virtual-only meeting. Glass Lewis has stated that beginning in 2019, it will generally recommend voting against members of the governance committee if a shareholder meeting will be held on a virtual-only basis, unless the proxy statement contains robust disclosure assuring shareholders that they will have the same rights and opportunities to participate as they would in an in-person meeting. So, what are the advantages and disadvantages of virtual-only meetings? The advantages to virtual-only meetings include the potential to increase shareholder participation, enhancing retail participation by allowing online voting during the meeting, reducing the environmental impact of meetings by lowering the carbon footprint, travel of all participants, saving the company money, travel, facilities, security, and saving shareholders money, travel, and possibly lodging. What are the disadvantages? The disadvantages of virtual-only meeting can be that they limit the shareholder in-person interaction with the company's executive and board and allow the company to avoid certain questions, don't take into account potential shareholder discomfort using technology, and may not allow for a fulsome discussion of contentious proposals. In fact, just this past April, a committee of executives representing retail and institutional investors, public companies, and proxy and legal service providers issued a principles and best practices for virtual shareholder meetings. This white paper outlined 5 guiding principles for virtual shareholder meetings, which were expressly not intended to create a higher standard than for in-person meetings. The white paper also suggested a number of best practices, such as creating formal rules of conduct and establishing reasonable time guidelines, which candidly appear applicable to in-person meetings as well as virtual meetings. Best practices identified in the white paper that specifically relate to virtual meetings include ensuring equal access for shareholders attending on a virtual basis by opening video, websites, and telephone lines before the meeting to let shareholders test their access, and providing a technical support line for shareholders that have any questions about accessing the webcast. At this point, virtual meetings have become a part of the proxy season landscaping. Using technology provides a platform that encourages meaningful shareholder engagement at the annual meeting. Companies considering or planning a virtual meeting should begin preparations early, and directors should be involved in the decision. Given this changing and inconsistent environment as technology meets historical practices, what should directors and y'all, the council, ask? Specifically, the board should confirm that their governing law permits virtual meetings and that their charter and bylaws contemplate the practice. Companies conducting virtual meetings must decide whether they will retain an in-person component of the meeting and whether the virtual component will be audio only or will include video. Other important considerations regarding a virtual meeting, whether virtual only or hybrid, include how to handle shareholder questions and whether to permit those who are not shareholders to observe the virtual meeting or to limit access to shareholders. And finally, it is critical for companies conducting virtual meetings, again, whether virtual only or hybrid, to be sure that technology is in place and adequately tested before the meeting. I'd now like to turn to my last topic, which is the SEC's 2018 update of C&DIs that are applicable to proxy rules. This past summer, the staff of the Division of Corporate Finance of the SEC updated its compliance and disclosure interpretations for proxy rules in Schedule 14A and C. Although generally consistent with previously published telephone interpretations manual, with 35 of the 45 new C&DIs representing non-substantive changes and 4 technical changes, 6 of the C&DIs represent what the staff considers substantive changes to the manual of publicly available telephone interpretations. In the interest of time, I'll just mention that specifically those 6 substantive changes include interpretations regarding name change proposals, omitting zeros in benefit plan tables, Note A disclosure with respect to authorization of additional securities, financials required upon elimination of preemptive rights, discretionary authority for cumulative voting, and the required filing of preliminary materials where there is no discretionary authority over a non-Rule 14A8 matter. I'd like now to turn the program over to Lauren Richmond. Lauren?
Thanks, Bob. Rule 14A8 governs the shareholder proposal process, and I'm going to discuss that first. I'm just going to give a quick reminder on a general point. You should check for technical deficiencies as soon as you get a proposal. Procedural grounds for exclusion can be the surest way to get a proposal excluded from a proxy statement, but there are particular time periods you need to pay attention to get notice of deficiencies out, as well as to allow for cure periods. And I'm also going to give you a hint. If you're considering whether to submit a no-action request seeking exclusion of a proposal, it can be really helpful to monitor the SEC's incoming Rule 14A8 requests to see if other companies have received similar proposals, and if so, how are they responding. I've included the link to that site on the slide. So, back in November last year, the SEC issued Staff Legal Bulletin 14I, providing guidance on 4 topics as noted on this slide. I'm going to focus on the SLAB 14I suggestion to include discussions of board analyses on no action request in the context of the ordinary business exclusion under Rule 14A8I7, which has an exception if a proposal transcends ordinary business due to its significance, and also under the Rule 14I5 economic relevance exclusion, and that one has an exception for proposals that are otherwise significantly related to the company. 2 days ago, the staff issued SLAB 14J, this new staff legal bulletin, and that elaborates on the type of details that it's looking for in a board analysis. At first, it seemed that the staff envisioned that board analyses would be mandatory, but the staff has made clear that it's optional. And I also want to point out that a board analysis is a description. You do not have to include board minutes with the no action request. A board analysis is definitely not a magic bullet. During the 2018 proxy season, the staff did not automatically grant no action requests for exclusions of shareholder proposals under I-5 or I-7 just because they contained a board analysis. No action requests were denied if the staff felt that the analysis did not provide a sufficient level of detail to conclude that the exclusion was appropriate. And these replies did not make clear what details the staff actually felt were missing, but we have more of an idea of that with the new staff legal bulletin. The staff also rejected no action requests in 2018 where relatively substantial amounts of shares were previously cast in favor of similar proposals. On the other hand, the staff granted no action requests when it felt it appropriate to do so, even if the request did not contain a board analysis. And even when the staff agreed with a no action request that contained a board analysis, it wasn't always clear from the staff reply how much weight was being placed on that analysis. But now we have the Staff Legal Bulletin 14J, which was issued on October 23rd. And it provides guidance on what the staff is looking for in terms of a well-developed board analysis. It also addresses the application of the ordinary business exclusion of Rule 14.8I7 to micromanagement, as well as to senior executive and director compensation matters. SLAB 14J has given us 6 examples of the types of specific substantive factors that the staff suggests boards may want to consider in reaching their conclusions about the significance of a proposal. And the staff made clear that these examples are not intended to be an exclusive list of relevant factors. And also, boards do not have to address each one of these 6 factors. Very briefly, the 6 factors identified by the staff are, first, the relationship of the proposal to core business activities, quantitative data that illustrates whether the matter is significant to the company, whether the company has already addressed the issue in some manner, the extent that the company's engaged with its shareholders on the issue, and how the shareholders reacted during that engagement. Also, whether anyone else has requested the type of action or information sought by the proposal, and whether the company's shareholders previously voted on the matter. So, should you have your board analyze a proposal if you're seeking to exclude it under Rule I-5 or I-7? That depends. Do you have strong arguments for exclusion under technical grounds, such as a faulty proof of ownership? Is there strong precedent that the staff is likely to grant a no-action letter on ordinary business grounds anyway, for example, based on a characterization of the proposal as involving micromanagement? If a significant number of shareholders voted in favor of the proposal on a similar topic in a prior year, do you lack mitigating developments on the issue for the board to discuss? If the answer to any of these questions is yes, it may not be worth the board's time to develop an analysis for a no-action request. According to SLAB 14J, the absence of a board analysis doesn't create a presumption against exclusion. But on the other hand, the staff has indicated that it considers board analyses to be helpful, and SLAB 14J expressly warns, and I'm quoting here, without having the benefit of the board's views on the matters raised, the staff may find it difficult in some instances to agree that a proposal may be excluded. According to the staff, this is especially the case where the significance depends on facts that may not be self-evident. So think of a board analysis as another tool in the box when you're seeking to exclude a shareholder proposal from a proxy statement under I-5 or I-7 where significance is being debated. While I wouldn't advise that a board analysis should always be included, I also would not likely advise dispensing with it. Consider the facts and circumstances of the proposal carefully, as well as the board's other time commitments, and make a deliberate decision. SLAB 14J also addressed the scope and application of micromanagement as a basis to exclude a proposal under Rule 14A8I7, explaining that the framework of whether a proposal probes too deeply into complex matters also applies to proposals that call for a study or report. And the staff also noted that its concurrence with a micromanagement argument does not necessarily mean the subject raised by the proposal is improper for shareholder consideration. And SLAB 14J also addressed situations where implicating senior executive or director compensation could be excluded as ordinary business based on the focus of the proposal, whether the particular form of compensation was generally available in the workplace, or because the proposal seeks to micromanage compensation. As for specific proposals, I won't spend much time on proxy access this year because it's been implemented at many companies in a market standard as developed, as summarized on this slide. As a result, proxy access adoption proposals, fewer of those were submitted during the 2018 proxy statement, although there were a number of fix-it proposals also trying to modify existing proxy access provisions. And there were quite a few proposals seeking to reduce the threshold of shareholders needed to call a special meeting. In an interesting development, some companies were able to exclude the proposal under 14A I-9 as conflicting with the management proposal. They did this by seeking ratification of existing special shareholder meeting provisions. I think everybody knows there's a growing interest in environmental, social, and governance proposals, both in terms of submissions and in institutional investor support. There have also been compensation shareholder proposals seeking to apply particular ESG metrics as incentive measures. Most shareholder proposals don't achieve majority support, but this slide lists examples of the types of 2018 proposals that did. When an environmental proposal gets majority support, you often see news items about it. But what I would like to note is more significant is that some of the types of governance proposals listed on this slide have average support in excess of a majority. So, for example, proposals to declassify the board in 2018 averaged 84.5% in favor. Not all the topics mentioned on the slide passed. However, some that did not attain majority approval did achieve significant support with over 30 or 40% in favor, and that level of support can have an impact on the company. I also want to mention that a new tactic for shareholder proposal developed last proxy season. Some proponents began filing notices of exemptions on a voluntary basis. These were notices of exempt solicitations that permit filers to make arguments outside the proxy statement on matters that are going to be voted on at the meeting. And these notices were sometimes filed multiple times throughout a company's proxy process. And these could be in support of a shareholder proposal or against a management proposal, such as say on pay. These filings don't have a word limit, and they do appear on the company's EDGAR filing page, which means anyone who follows the company can see them. And if they've signed up for alerts, the filing notice will be pushed to them. It's a relatively inexpensive way for proponents to get attention. They just need EDGAR codes if they don't already have them and to arrange for EDGARization. The SEC issued 2 C&DIs this year permitting these voluntary filings but requiring cover page information, which is easy to comply with. Companies don't need to reply to these notices, and there's no need to post them on their voting websites, and it's likely to be a common practice in the upcoming season, more common even than last year. So companies should be monitoring their EDGAR filing pages with them. And with that, I'll turn the program over to Anna.
Thanks, Laura. So I'm going to change gears for a little bit and discuss some of the topics that ought to be top of the list in terms of preparing the Form 10K or Form 20F for 2018, as well as topics that are likewise going to be important to raise with the board, as well as with audit committees and risk committees. So first in that list is, of course, cybersecurity. It's difficult to avoid mention of cyber security if you're attending any conference on securities law issues. And so we began the year with the Securities and Exchange Commission issuing an interpretive release. The release, as we note on the slide, essentially reaffirmed the guidance that had been published in 2011, now with significant additional guidance from the Commission on the types of issues, both disclosure-related, financial statement and internal control over financial reporting related, as well as related to governance. And so I'm going to touch on each of these, beginning with disclosures. So the Commission, in its February guidance, as well as in various public statements made both by commissioners as well as by staff representatives, have emphasized the importance of making sure that companies are detailing in ways that are specific to their industry, their businesses, and the particular risks related to cybersecurity, cyber breaches, and doing so in ways that provide very tailored disclosures that are not generic. So to date, if one were to study filings from a range of companies across different market caps and across different industries, there's a surprising consistency in the types of risk factor disclosures that you might find related to cyber and cyber breaches. And of course, depending on the company's industry, if it's a regulated business, for example, a bank, a broker-dealer, the risks are quite different than, for example, those that might be applicable to a consumer products company or a company that transacts most of its business through or on the Internet. So during this reporting season, you can be sure that the SEC staff is going to be quite focused in light of the Commission guidance on seeing more detailed, more tailored disclosures of the specific risks of cyber breach issues, as well as detailing incidents. So actual experiences that the company has had with breaches, and of course that raises interesting questions regarding the appropriate timing for disclosures. So when is it appropriate to publicly disclose the occurrence of a breach, the occurrence of an investigation related to a known breach? That similarly raises concerns about the appropriate MD&A disclosure. And that's another topic that was addressed in the Commission's guidance. There the Commission highlighted that their expectation is that registrants are going to provide fairly detailed disclosure in their MD&A regarding the effects on results of operations of cyber breaches. It might have impacted the company's relationship with its customers, affected the company's integrity, the integrity of customer data, lack of security efforts or remedial efforts, and whether those in fact led to regulatory inquiries or investigations, or even litigation where it might have been appropriate for the company to have made an assessment regarding loss contingencies. And so we provide on the slide an example of a recent SEC staff comment regarding loss contingencies. In addition to focusing on the disclosure issues, the Commission, of course, also has been focused on enforcement. So there have been some recent enforcement actions that provide good reminders for companies, one related to a company's failure to adequately disclose the occurrence of a cyber breach. So here, disclosure controls may have pointed out or brought to light that certain of the risk factors that the company continued to use were fairly generic and, as noted on the slide, spoke to future or possible cyber breaches, whereas indeed an actual breach had occurred. So there were disclosure deficiencies that the Division of Enforcement identified, and those all serve as good reminders for boards and for disclosure committees to consider when they're reviewing year-end filings. Another area of focus relates to insider trading. So directors, officers, or other control persons trading, while aware of the occurrence of a cybersecurity incident that has not yet been publicly disclosed. So again, here a good lesson and reminder to review the company's communications policy, its Regulation FD policies and procedures, as well as its blackout or insider trading policies and procedures, and understand how those would be implicated once the company does become aware of a cyber breach. Most recently, just a couple of days ago, the SEC's Enforcement Division released a report of investigation pursuant to Exchange Act Section 21A, and this highlighted some issues with an inquiry that the division conducted of 9 companies. It chose not to pursue enforcement action against these, but these companies had been victims of cyber-related frauds, and the Commission pointed out the importance of ensuring that companies have appropriate internal accounting controls so that those provide protection against cyber-related incidents. So since we're nearly or almost out of time, really, I'm just going to quickly provide some other highlights and leave you to look at the slides as a reminder when you're thinking about year-end reporting. So obviously some important reminders there regarding the various policies and procedures that may be implicated when a company is discussing and assessing its cybersecurity readiness with the board, as well as with audit or risk committees tasked with cyber breach oversight. In terms of disclosure considerations, there are a number that should be top of the list in terms of reviewing the 10K cyber, which we touched on. Of course, Brexit for certain companies, depending on geographies and business lines. Tariff disclosures, again, very dependent on the company's industry and products. Non-GAAP, and we thought that this had died down, or at least that companies had made all of the necessary adjustments in light of commission guidance and staff guidance on the use of non-GAAP financial measures. But here we're seeing renewed attention specifically on key performance indicators or tailored measures of performance. We highlight as well some accounting-related issues, so RevRec, and addressing the Staff Accounting Bulletin 118 on the effect of the Tax Cuts and Jobs Act and making sure that those tax-related consequences are fully disclosed, particularly in MD&A. And then, of course, in reviewing this year's 10K, it's important to take into account the effectiveness of the Commission's recently adopted disclosure updates and simplification amendments. And on the slide, we highlight, just in the context of the K alone, some of the changes that are brought about by those amendments. And then lastly, as a concluding thought before I turn things over to Mike, of course, reminders as well, more for the audit committee and audit committee discussions. Audit committees, of course, will be interested in understanding how companies have implemented, both from an IT reporting and controls perspective, measures to comply with the new lease accounting standards. And although we've got a year to go, many boards and audit committees will want very much to have a conversation this year with the company's auditors to start digging in and preparing for critical audit matters for CAM reporting next year. So with that, I'll turn it over to Mike.
Thanks, Anna. That wraps up today's program. I want to thank Candace, Bob, Laura, and Anna for participating along with me. And on behalf of Mayor Brown, I want to thank you for your time. We hope you found this program useful. Be on the lookout for future invitations for programs that may be of interest to you. Some final housekeeping items for today's participants. A recording and link to the materials from this program will be distributed by email to you in the next day or two. Thanks again for participating, and this concludes our webinar.